COVID-19 has made an impact in our lives in so many ways, but many of those we still don't know what the impact is going to be. So it's really today is why what we're here for is getting a better understanding of the future impacts. Today's global business and commercial real estate trends will lead to tomorrow's impacts. The decisions of industry and businesses will impact our local government revenues, our retail and restaurant community, and our future transportation infrastructure needs, and that's just a few. Which is why I'm very, very excited to have Gregg Healy with Colliers International and Mike Petrivelli from CoStar joining us today. Both guys are located in Southern California, so this is an early morning for them, and we appreciate their willingness to help out. So instead of introducing them each individually before their presentations, I'm going to cover both their bios right now. Gregg is the Senior Vice President for Labor Analytics and Supply Chain Solutions at Colliers International. His experience prior to Colliers was within the industrial sector and included establishing a Japanese plastic injection molding subsidiary in the US and serving as Vice President for a Honda logistics firm. Gregg's business background gives him a good perspective of what firms are looking for when they expand their operations, especially as it relates to workforce and access to supply chains. Michael Petrivelli is an attorney and the CoStar market analyst for Denver and the greater Colorado region. Prior to CoStar, Mike worked for a law firm and was involved in a wide array of cases, including those related to real estate law. His work at CoStar has helped developers, investors, and lenders leverage analytics on a metro and submarket level. And his understanding of the Denver market in particular helps us understand how our region has responded to the pandemic and what we might expect coming out of it. So I'm going to hand it over to Gregg to get started. Thanks.
Thanks, Chris. And thank you for the Denver South Partnership for inviting me to speak today. As Chris mentioned, it's been a wild ride. We thought 2020 was going to be an amazing year. We had some great tailwinds behind us going into 2020. And then all of a sudden, March hit. And so let's talk about what's happened since your last meeting in February in the greater economic environment and what we look forward to in the future and how we can basically pivot our business models to address these changes. Next. Oh, there we go. Next one. So as I mentioned, we ended 2019 with some great numbers, really great. If you look at the bottom line here, this graph, we're showing you how the unemployment rate, particularly for the Denver, Aurora, Lakewood MSA, looked at the end of 2019 and how it looks basically in April with the latest labor numbers. 2.3% unemployment rate in December of 2019, juxtaposed against 12.1% unemployment rate in April 2020. In just 4 months' time, we've shifted from having almost record low unemployment nationally to having almost 30 million people unemployed today. And even Goldman Sachs, who's pretty good at these numbers, they predicted having about 16 to 20 million people unemployed by Q2 of 2020. We're really far off at 20.5 million. Now, one thing I can say is that the level of increase in unemployment claims has tapered off a little bit more, and we're hoping that at some point we can turn the corner and improve upon this. But right now it's pretty rough, and things are definitely in flux. Really, from the COVID-19 pandemic, what we've learned is this is not just a medical pandemic, it's really a supply chain pandemic. And the supply chain has impacted so much of industry across the world. We think about how it first started in China, and we had shutting down of manufacturing locations in China just right after the Lunar New Year. Many American companies had already built up stock of inventories of products to be sold prior to the holiday season because it was an anticipated shutdown. But when they extended the shutdown after the Lunar New Year, we started seeing an impact on our supply chains. And then later, as the pandemic spread across the globe, we had a real mismatch of demand and supply. Whereas China, as it was rebooting, coming back online, much of the West was just starting to feel the impact. And our retail stores were closing. We had hospitality groups as travel stopped closing. We had manufacturing. We had oil and gas tank, literally, in pricing. We had all these different sectors of our economy start to collapse. And the challenge we see going forward right now is how far can we continue on this whirlwind down until we can get off it? And that's really what we see is the challenge. The good news for Denver South particularly is, if you look at the industries that were most impacted by COVID-19, it's really not the industries which are the core industries of your market. So what are companies doing now? What are communities doing now to pivot, to shift, to reopen, and what will change going forward? That's kind of the thesis of what we're going to talk about today, in the next 10 minutes or so. Let's continue. And there are three real trends that we see coming out of COVID-19 that will impact us going forward. The first one is the rise of e-commerce. If you look at e-commerce as a percentage of overall retail sales, last year it ended around 11%. But you can see in this little tiny graph I put up here that it's starting to increase dramatically. You're seeing increase of 100% year over year from last year. You're seeing companies like Walmart with their food business with a 360% increase versus last year. It's phenomenal, this shift, and the rise of e-commerce is sustainable. The next main topic, our theme, is the reshoring or nearshoring of work, and we're going to talk about what that impacts to Denver South specifically. Lastly, the third really big change, and I think the most impactful for your community specifically, is the distributive workforce model of going forward. If you can work anywhere, where would you choose to live and work? Next. So we're going to dive in first to the impact of the e-commerce and how e-commerce is going to shift our buying habits, and not just for today, but going forward. What's very fascinating for Americans to note is that when you look at, again, overall retail sales and e-commerce as a percentage of the retail sales, very small in the US compared to other countries. Looking at this slide here on the left, if you look at 2020, China was already at about 40%, 44% of overall retail sales being done online. 44%, 11% for the United States. And they were trending to have about almost 2/3 of overall retail sales online in just 3 years. A majority of those also on m-commerce via cell phones. The United States totally lags behind this. But we're shifting. And this COVID-19, similar to SARS in China, has been the catalyst for the shift. When you hear that general retail is up 209% year over year, April to last April, 74% in March, online gaming, because people are so bored at home sometimes, also up 126%. And of course, my favorite one to highlight is liquor sales up 208% versus last year, because people are saying, I can't go out. As Chris said, no more going to the bars after work. What do you do? So, right? And like similar people, I have 3 children at home who are trying to get through an education program from home. So it's a big change. But these trends that we see are not trends which are new. They're just trends that are actually being compressed, a decade's worth of change being compressed in the course of 3 or 4 months. So no one's here, I believe, really thinks that a Nordstrom or a Macy's is really going to go full on with a retail brick and mortar strategy. They've already been shifting over to the e-commerce platforms, and now this is only accelerating this. So what's interesting to look as we compare and contrast, the American e-commerce model versus other models in the world, particularly Asia, which it seems pretty advanced. In America, we still tend to think that if we get our shipment in Amazon Prime and it comes in 2 days, we're doing great, right? And Amazon's trying to shrink that. And the biggest trend we see in e-commerce is consumer expectations are saying we have to get faster at delivery model. In China, 90% of all e-commerce orders that after you click and buy, they're delivered within 24 hours. Think about that in the United States. Think about how we need to develop infrastructure in our communities to support e-commerce going forward. So this is something I think will be a transformational shift. And yes, we will see some of this, the necessity of shopping online retreat a little bit as things normalize. But still, after 28 days, people tend to normalize these sort of behaviors. And so people will say, it's just more convenient for me to buy things online. It's better and easier for me rather than going out and going to stores to have things delivered at my convenience through the omni-channel model. Particularly with e-commerce, we're seeing new entrants into the e-commerce platforms. In the past, in the site selection world, when we're looking for locations to find e-commerce distribution centers, we're looking at areas where you have a high level of a community where you have very younger, more educated, and wealthier consumer base. But now that's changing. We're seeing older consumers, seniors, very much interested in having their groceries delivered online. So this is something, and these are the areas where we see that are hiring, where we've seen a lot of layoff in the brick and mortar retail spectrum. We are seeing tremendous hiring when it comes to home delivery, e-commerce world, and of course, medical as well. Next. And so if you think about how this applies to our world, and your world specifically in Denver, I'm showing you a quick example of, even though Colliers is known as commercial real estate firm, we're really not about the building. We have to think about all of the inputs that surround the building, because the price of the building, it really isn't a dramatic change point, or the delta in a lease rate doesn't move the needle. It's about the other qualitative measurements that we look at when we're deciding where to locate a facility. So a lot of that's around transportation, a lot around network optimization. We're talking about labor markets, very, very important. Prior to March, labor was very, very important. And Colliers addressed that by saying, let's put together this workforce analytics platform to help address companies that are trying to find that very finite pool of labor. But now that's changing. But the key drivers for the industrial side will still be the same. They really will be the same. It's about locating around transportation cost. It's about locating around large communities, populations of consumers. So when you think at Denver South particularly, Denver South will continue to grow in e-commerce, and it will continue to grow as a regional player. It won't be because it doesn't have direct access to inbound ports such as Long Beach or New Jersey or Savannah. It won't grow there, but definitely you'll see an increase in industrial locations around e-commerce and last mile fulfillment. So that concept of being closer to your consumers, it will only continue to grow. And so that means you will see a shift. And we're seeing it already where we have areas of retail, which are blighted out, and now they're being shifted over into create industrial spaces. And so quickly, what you're looking at here is you're looking at some of the modeling we do to locate in site selection, industrial sites or manufacturing sites. And it's still all the similar drivers, but we also have to include that very important factor now, that factor of resilience. Making sure that when you have a supply chain, it's resilient to disruption. Next. And that goes to the next topic, that idea of resilience. What does it look like? This is a huge theme that's been really circulating around the supply chain communities. How do we build more resilient supply chains? And this is not something which just came up from COVID. It's something that's been percolating for years. Pretty much since 2010, we've seen an increase in manufacturing jobs in the United States. And we see, of course, foreign direct investment growing in the United States, and we see, of course, reshoring of jobs. But this is not driven specifically by policy as much as it is by the consumer. The consumer is saying, again, faster, cheaper, and better. How do you do that? And I've come from the automotive background with Honda, and think about automotive suppliers and automotive manufacturers, first manufacturing in Asia, then bringing it over to the United States, and now globally sourcing. So we're going to see that continue to develop. The challenges with China, and that's basically the giant 800-pound gorilla in the room, have been compounded in the last 3 or 4 years with Trump administration. And that is things such as tariffs. We have labor arbitrage issues. We have challenges with speed to market. And so now with COVID, you also have business insurance costs, really looking at all the risk. So companies are saying, now is the time for us not to move out of China, but to revisit our supply chain, to think about, is it time to say China plus one model? You wouldn't leave China if you're thinking about what I said earlier of being closer to your consumers. When you have a market in China with a middle class, which is larger than the entire population of the United States, you have a manufacturing basis, which is larger than the population of California times 2. You wouldn't leave China, but you try to understand how you diversify, how you create a plus one model. Is that plus one model Mexico? Is it the Southeast United States? Where can you think about building a supply chain to have that resilience? So when the supply chain breaks, as we've seen in the last couple of months, your business doesn't fail. Next. So we've seen this shift, and this shift we're seeing is really about risk mitigation. It's not about maximizing return, it's about risk mitigation. And so if you look, I put this chart in here, and we're saying Denver South, is that really the place people will be migrating their or reshoring manufacturing jobs? I'm going to say Probably not. That's probably not the prime place. Yes, certain industries, absolutely. Technology, aerospace, that's you're really prime, and healthcare suited for that. But if you look at from 2010, 2018 and say which states have been the biggest benefactor of reshoring and the biggest benefactor of foreign direct investments, probably not a lot of people would have said South Carolina, but South Carolina has been. And if you look at the top 10 up there, they're pretty much regionally all in the Southeast. And it's for these prime reasons. You have proximity markets. You have areas where the highest and the fastest population growth in the United States. You have right to work. I know Colorado has a hybrid model, but oftentimes in site selection, part of our questionnaire to our clients is how important is a right to work state? And if they don't have a right to work state, it's sometimes off the short list quite quickly. Of course, low cost and available labor is very important for manufacturing distribution models, and high incentives in the Southeast as well as they're trying to improve their economies. It's not the same model in Denver, particularly because you're a more mature model and you have a much different focus than the Southeast. So, and port access is critical too. So when you think about what's going to impact for the reshoring or the nearshoring of jobs, I think we'll see a larger benefit located along in the Southeast, particularly on Asian clients looking to reshore or move jobs to the Southeast. But also you'll see a resurgence of opportunities along the border with Mexico. When you look at just this year, and traditionally or historically, we see LA Long Beach being the #1 port of entry for goods manufactured overseas. This year, 2 months out of the year, we've seen the inland port of Laredo, Texas, surpassing Long Beach in LA as the #1 port of entry for goods coming into the United States. That's really, really interesting to look at. How does that look going forward? You can go to the next one, that's fine. They're pushing me along, I tell you. No. So this is a little bit small perhaps, but what I want to focus on, this was provided from Denver South, and this is really looking at what are your industries, what are your industry mixes, and how does this impact you? Your employment sector is really based around professional business services, financial activities, health and education activities. That's over 50% of your business, your jobs in the market. Secondarily, you see leisure, hospitality, information technology, a very strong one still, and retail. So I highlighted in red the areas which are weaker areas, but the areas in blue are areas that are sectors that are really primed for growth. And I know it's a little bit small on this graph here, but this is a really important survey to look at which areas or which sectors were impacted most and which were impacted least. So if you look at the bottom going up and you look at which areas have been least impacted by COVID, it's really those jobs where you can work from home or work remotely in the professional areas of white collar employment. So COVID-19 has been definitely a pandemic which has basically been a bifurcated model of how it's impacting people. We're seeing people who are more hourly workers, though they've been impacted to a greater extent than the salaried professional white collar employee at this point. But will this continue? We shall see. We shall see again, if we, in this whirlwind, if we see a precipitous drop in consumer demand because those people are not employed and do not get reemployed quickly, we might see a shift, and we might see a shift towards a greater dependency on gig economy workers, not just in the blue collar industries, but also in the white collar industries. And so that goes to the next trend, please. Next slide. This is a very interesting trend that's emerging from COVID-19. We already saw it in millennials as well, but think about this going forward too. If the idea of distributive workforce, and distributive workforce means people are working at home now, and think about all your metro centers around the United States, areas like New York or downtown Los Angeles or Chicago, and downtown Denver as well. Think about all the legal firms, the accounting firms, the consulting firms that have large presence and footprints in these areas. And now they're recognizing, you don't have to be there anymore. Look at companies like Facebook saying, you don't have to come back to the office ever again. You can work remotely, and you can work remotely anywhere. How does that impact us as site selectors? How does that impact us as communities as we look at how do we define the place? How do we attract the highest level of talent to our communities to drive this never, always hungry engine for talent? So think about that. And I say, Denver's been, fortuitous in the sense that you're blessed by natural beauty. And we look at resilience from COVID-19, and the areas which are coming back quicker are the areas that have the ability to spread out. They're not so dense. They have campus concepts versus downtown inner core concepts for businesses. So think about, for Denver, how that plays out going forward. You think we have technology, talent, and tolerance. And this is not my own phrase. This is from Richard Florida and his concept of what drives a really vibrant community. And I think that's what you'll see. If you keep developing your brand as a community, you'll attract the right sort of talent. And you've been very successful in the last 10 years or so of having this highly educated, very diverse when it comes to talent pool in industries. I think that you should continue to really focus on that. Millennials and the new generation talent can work anywhere. They want to love where they work. They want to have that ability to mix live, work, play. And Denver has that. Denver South possesses that. So think about that. My last question to you is, where would you want to live if you could work anywhere? And I think Denver has a lot of natural attributes, and you're cultivating and curating a talent pool to keep that going forward. So those are my comments to start open up with this morning. We'll take questions at the end of the conversation. And last comment, and this is for every presentation I give. I always say what's really important is that we always have to continue to evolve. You have to. It's not the strongest, not the most intelligent. It's the one who's most able to respond to changes out there. And so COVID-19 thrown as a curveball, but as long as we respond to it positively, we can come out ahead. Thank you.
That's great, Greg. Everyone really loved the presentation. We got some comments already, and hoping we can share your presentation with everyone after we're done today.
Absolutely.
Great. Now I'm going to hand it over to Mike Petrivelli, and just remember, please send us your questions in the Q&A button, and we'll take those at the end. Thanks.
All right. Hello, everyone. Can you guys hear me? Just to make sure. Okay, perfect. Well, thanks again for having me on. I really appreciate it. Great presentation by Greg, and I think my presentation will be a good piggyback to a lot of the stuff that he mentioned. Today we're going to kind of look at just the overall employment picture, what's happening on a macro level in Denver, because as you all know, jobs are a huge driver for commercial real estate and our forecasts. So that's kind of what I'll touch on a little bit at first, and then we'll go into the forecast. So you go ahead and change the slide, please. So in the latest reading from the BLS, Denver lost about 165,000 jobs in April. Should come as no surprise that the hardest hit sector was leisure and hospitality, which lost over 64,000 jobs. It's about a 43% decline annually. Trade, transportation, and utilities, which includes retail, lost more than 29,000 jobs. Work from home friendly industries certainly fared better. But I mean, this chart here just brings home the overall impact, the severity, just a shock that we've never seen before. And this certainly has affected our models because there really is just no playbook for this at all. So kind of wanted just to bring this home here with this chart in terms of looking at how many jobs we've lost in April, and it already dwarfs what we lost during the Great Recession from 2008, 2009 by 100,000 jobs. So more than 100,000 jobs were lost in April versus 2008 and 2009, which is pretty astounding. Next slide, please. And then further looking at the breakdown, overall breakdown of what was lost, as I mentioned before, leisure and hospitality, hardest hit sector, but then your work from home industries really fared well, and this kind of goes along with what we all thought with these industries would weather the storm, and even before this recession hit, this is kind of what we always would talk about with Denver in terms of weathering the next recession, because it is very focused on office using sector jobs, that it would perform better during the next recession, and this is before the pandemic hit. So this is really what we've seen here, and of course the government, the state capital is here, so the government jobs have also fared really well, and this has really been a strong market overall. When we look at unemployment currently, it's at about 10% in Metro Denver, and then versus the national average about 14.7%. So clearly it is outperforming on a national level. And then Denver South in particular, since it is such an concentrated office using hub and does not have the exposure to a lot of the harder hit industries, specifically oil and gas. It has performed on a sub-market level when we look at the different sub-markets in Denver South remarkably well. It's really held up well. So that has been a great sign. Next slide, please. This shows us the our baseline scenario for our forecast. So this is based on Oxford Economics baseline forecast. Oh, sorry. If you go back to the baseline forecast there. There we go. So this forecast projects more than 245,000 jobs will be lost in the second quarter. So currently, as I said, we're about, given that the jobless claims in May were around 100,000, we're probably around that number currently. But I mean, there's a lot of unknowns. We don't know how many jobs will come back this quarter as the economy reopens. But this scenario projects 245,000 jobs are lost in the second quarter. The recovery begins in earnest in the second half of the year. Denver reclaims about 150,000 jobs by the end of 2020, but employment does not return to pre-pandemic levels until the end of 2021. Next slide, please. The moderate downside scenario that we have here, total job losses for the second quarter amount to about 300,000 in Denver. This is similar to the baseline forecast. The market begins a strong recovery beginning the third quarter and regains about 227,000 jobs by the end of the first quarter of 2021. However, what follows here resembles another contractionary environment where we lose about 84,000 jobs. So another protracted recession happens here following the rebound. So this is kind of our double dip scenario where, because of, a fast reopening economy and we still have the virus spreading, it does lead to a protracted recession here following in the following quarters as jobs start to bounce back. So this is our moderate downside scenario that we have here. Next slide, please. And then looking at our moderate upside scenario, so this, you could consider this your V-shaped recovery that a lot of people reference. This is a scenario where we only lose about 55,000 jobs in the second quarter. So this is assuming a really strong bounce back here in the second quarter as we reopen. Obviously, this is pretty unlikely at this point, but I think it's worth mentioning because a lot of people are talking about a V-shaped recovery and what that looks like. And if this does, we do surprise the upside, this is what we expect to happen. Only around 55,000 jobs are lost. Then we end up adding about 67,000 jobs in the second half of the year. So, and then we expect quarterly employment gains to remain positive throughout 2024. Next slide, please. And then this is our office forecast, which obviously for Denver South is probably the most relevant forecast for our purposes here. There's been a lot of talk about where the office sector is going now that everyone is working from home. I think, oh, sorry about that. You could pause that, please. I think there's a lot of discussion, about where we're headed. And I think some of it is probably a little overstated. I think, certainly work from home is becoming more and more of a trend. But I think, people say, the fact that people are saying office, buildings or their days are numbered, I think that's probably a little too aggressive. I think there's a lot of value that you get from having people in the same space, innovating together and collaborating together. And there's something lost when you do work from home. So that environment is a big reason, I think, before the pandemic, where we saw so many office using companies cluster in major urban centers. It's because of that dynamic. And it's been proven that those areas have fostered, the greatest innovations and really the most productivity. And I think, there's something to that. I think in the short term, certainly you're going to see more and more people want to work from home just because of the health situation. But as we move on from this, I think the longer term trend is going to revert back to the mean, where we still want to be close together in terms of clustering talent together, and that really does foster a healthy office working environment. And some other thoughts, just based on stuff that we've heard from CEOs like Mark Zuckerberg, in terms of wanting to expand his workforce outside of the Bay Area. The main reason why he's wanting to really expand these work from home policies is to expand the talent pool. So he's not just limited to the Bay Area anymore. He can go to other tech markets, Denver, Raleigh, all these other places, and set up outposts there. And I think, when you look at trends that we've seen in Denver, the past decade or so, we've seen a lot of West Coast tech firms move to Denver. And I think, along that vein, it's because of the talent base here. So I think you will continue to see that moving forward. I mean, we already seen a lot of tech firms kicking the tires even during the pandemic. So I think that'll only continue and perhaps accelerate that trend here. So sorry for the long-winded preface to all this, but just wanted to kind of address a lot of the long-term office trend concerns that people have been kicking around, and also the fact that a lot of these office leases are 3 to 5 years or longer. So a lot of these changes won't even be immediate. But looking at the forecast here, this is our baseline scenario, how this plays out. If we could go back, sorry, to the beginning there of that video. So I mean, the exposure to oil will certainly play a big role in the near term. We expect a lot of negative absorption here in the coming quarters. A lot of that is driven by oil and gas tenants. So here in our baseline scenario, we expect vacancies to peak at about 13% by 2021. Certainly, a lot of that is driven by oil and gas tenants. And then as we look at the moderate downside scenario here, this results in a similar rise in vacancies, but we have prolonged weakness in the job market, as we mentioned before, the double dip here. So it pushes the real start of the recovery of Denver's office market until 2023 and 2024. And then finally, here in the severe downside scenario, the moderate upside scenario, we have a much shallower trough, and then it rebounds really quick here. So this is a really protracted recession that we're looking at in the moderate upside scenario. So this is just kind of give you guys a view of several different paths that we could go down here, and really no one knows where this is headed. If they tell you they do, they're lying. So that's why we provide these different scenarios, just to kind of give us an idea of the potential paths that we may be heading down here. So next slide, please. This is our rent growth forecast. So daily asking rents that we collect in Denver have really held up very well. They've remained fairly flat since the pandemic. And this has also been one of the best performers Denver has been one of the best performers in terms of rent growth over the past decade here. So our baseline forecast, we have rent losses in the coming quarters due to lower levels of business investment, and it does drag on office demand, as we've seen. Rents are projected to bottom out at about $2.10 in early 2021. So we do have pretty sharp decline here in terms of the rent growth impact. Sorry, here I think we're in the moderate downside scenario here. If we can play the video, rents in the moderate downside scenario, they do falter as well, but suffer deeper losses overall because of that double dip scenario. And the bounce back is also relatively weaker as compared to the baseline scenario, largely due to minimal office demand and a really soft job market here. And then as we look at the moderate upside scenario, again, a much shallower trough overall. This is really a minor recession that we're looking at. And it's similar to what we saw in 2016 when oil prices dipped below $30 per barrel. So I think this could be kind of analogous to kind of the oil slump scenario that we saw play out in 2016 in terms of how much it impacted rents here. And then next slide, please. We'll take a look at the Denver multifamily market here overall. Again, office and multifamily really, they go hand in hand. A healthy office market typically lends itself to a healthy apartment market here. So as we look at, the multifamily projections here, this is our baseline forecast again. We estimate that, vacancies heading into the second quarter here around 8%. Obviously, we have a lot of supply pressure, particularly in downtown, and this is where Denver South is somewhat insulated from the supply pressure that we see in particularly downtown and other parts of the metro. So we don't expect to see, nearly the overall impact that we see on a metro level here that we see in Denver South. That being said, we do expect vacancies to rise in the metro near 11% by mid-2021 here in this forecast, and then vacancies return to pre-pandemic levels by 2024. We play the video here and look at the moderate downside scenario. Thank you. We expect the market to follow, a similar trend in the moderate downside scenario, with vacancies peaking at about 11.5% mid-2021. What follows, though, is a much slower recovery, again, plagued by weaker absorption due to a really soft job market in that double dip scenario. And we don't expect demand to really return in force here until 2023. In the moderate upside scenario here, we still do see a rise in vacancies, but again, we see demand bounce back much stronger. And then, really it's going to be a temporary protracted recession again, in terms of what we're seeing play out in the fundamental outlook. Next slide, please. So as we know here, in Denver, the Colorado Apartment Association has recommended that landlords halt evictions and waive late fees. Overall, it looks like rent collections have been fairly well above 90%. So that collection rate has been holding up pretty well. So that's been good. I mean, whether, this maintains momentum here heading into the later months of the year remains to be seen. I think there's a lot of downside risk that we look at, especially coming in August. We'll see unemployment benefits and supplemental benefits start to wear off for a lot of people who applied earlier in the year. And then, the PPP, it does start to expire. I think it was recently renewed last night. So that does maybe remove some of the other downside risks that we're looking at in terms of the PPP program. I think, this could go a lot of different ways, the forecast, depending on how those scenarios play out. So, supply-rich markets here have not fared well overall in terms of rent performance. Denver certainly falls in that category as a whole, primarily downtown Denver. Again, Denver South is somewhat insulated from that trend. So if you look at, just as a sidebar here, if you look at, Denver South submarkets within CoStar, you will see that, the overall impact in terms of rents is not nearly as sharp here. So I think that really does speak to, how we view Denver South in our forecast. It's going to be able to weather the storm a lot better than Metro Denver as a whole here. So looking at the baseline scenario in terms of rent growth, we do expect annual rent losses to occur for 5 straight quarters here, but we do get back to positive growth, strong positive growth by mid-2021. We get several quarters of robust gains that propel the average rent near to pre-pandemic levels by 2022. And then all gains are somewhat choppy in the remainder of the forecast. As you look at the moderate downside scenario, if we could play the video, sorry. The market endures annual rent losses for 6 straight quarters here. Rent growth does not rebound as strongly as in the baseline forecast due to weaker demand. And here the average rent returns to about 93% of the previous peak. And then, sorry, I think that's our moderate downside scenario here. And then the final one here is the moderate upside. Again, overall, just much shallower trough and then a stronger bounce back. but we do expect, overall slower rent growth in the later years of the forecast. And these are also, a lot of this has to do with demographic constraints, with labor force growth. This is stuff that we talked about before the pandemic, in terms of the overall national economy starting to slow, because we will see more people leave, baby boomers leave the workforce. And I think that does, that will kind of weigh on this in the later years of the forecast. Next slide, please. Now we're going to take a look at the retail market. So we've compiled a list here of some high-risk retailers based on credit rating. So in order to capture, the exposure to store closures. Yeah, sorry, if we go to the next slide. Yeah, high-risk retailers. In order to capture exposure to high-risk, retailers that are susceptible to store closures. Any retailer here with an S&P rating of BBB minus or lower is flagged, along with a number of other retailers cited as high risk by other credit rating firms. So we have J. Crew here, Neiman Marcus, Pier 1, At Home, JCPenney, and Sears. And although Denver is not overly concentrated, next slide, please. Although Denver is not overly concentrated in retail employment overall, it does have one of the nation's highest concentrations of retail space occupied by high-risk retailers. So roughly 6.4% of retail space in the metro is under the high-risk category, and that's behind only Orlando and Jacksonville. And that could even understate the risk to Denver's retail market, as thousands of independent shops and restaurants also may struggle to reopen. So this is, something to consider, and we do expect, some major changes to the retail sector. We're just not going to be coming back to all the same shopping malls that we're used to. We expect a lot of these distressed assets to hit the market, and we wouldn't be surprised if a lot of these buildings are repurposed for other uses. Even last mile distribution has been floated around as a possible use for a lot of these locations. So again, this is probably going to be the sector that we'll see the most transformation in, even more so than office. So that does it for our projections here for CoStar, and be happy to take any questions on the other side. Thank you.
Thanks, Mike, and thanks, Greg, for your presentation as well. We want to make sure that the audience submits questions. Please click the button for Q&A. Becky has been collecting those. So Becky, I'm going to hand it over to you to ask Mike and Greg some of these questions.
Great. Well, good morning, everyone. Thanks for submitting questions. And Michael and Greg, thanks for the great insight this morning. It was great to hear. We do have a couple of questions. This first one is from Jeff Hallwell. He's with the city of Lone Tree. And Michael, I'm going to direct this to you. As people return to work and gas prices rise, do you expect the oil and gas sector to return to their Denver offices? Or do you expect that it'll lead to displacement in other markets?
We've already seen a lot of sublease space come on the market from oil and gas tenants in the CBD. So, I mean, unfortunately, a lot of small and mid-sized U.S. shale companies are going to be wiped out here. That's just the reality of it. I think, we will see a rebound, certainly, in oil price. We already have seen a rebound, so that has been a positive sign. But a lot of these companies have already shut down their operations and prepared for, significant downsizing. So there's going to be winners and losers, certainly. I think, obviously your bigger oil firms are going to survive, Chevron, Exxon, but unfortunately the smaller outfits are most likely, going to be hit really hard here. So we do expect a lot of job losses in the coming months here for that sector. So we're already seeing availability spike up in terms of the availability rate that we track in Denver. It's already spiked up to levels that we saw in 2016 when oil prices were last below $30 a barrel. So we're seeing the same downsizing and restructuring happen already And then I think that's really, evident in the sublease space that's come on the market, sublet space that's come on the market. And we do expect to see more space flow into the market in terms of what's available. So unfortunately, that is a sector that is going to get hit really hard in Denver. And there's a lot of different factors to that, but I will say that, yeah, we do expect a lot of sublet space to come on the market, but I think that does open the door for more tech tenants to take that space. Tech tenants that were considering moving to Denver, and now, certainly it is a tenant's market, and they'll be able to take advantage of that sublet space. So I think we're going to see this churn of oil and gas tenants start to kind of whittle away in Denver, and then be replaced with tech tenants and other professional business services industries.
Great, thank you. Two questions that are very similar. One comes from Michael Patton. The other comes from Neil Marciniak at the City of Centennial. Can you, and I'm going to direct this to Gregg, but Michael, feel free to chime in. Can you share an opinion on how a remote workforce will meet in person to brainstorm, bond as a team, have interpersonal relationships? So how will we really keep the almost the face-to-face component of our workplace alive? And then I'm going to expand on that a little bit. How can organizations like Denver South encourage or support those connections?
It's a great question, and it's on a lot of people's minds right now. What's the role of the office space, and how do we move forward with office space? Within Colliers, we did a global occupier guide survey amongst our office users, and we found that many people wanted to go back to the office. Maybe not full time, but maybe 2 days a week was kind of the highest return of respondents. So there is an opportunity to return to the workplace again. But perhaps, and we're seeing it already, we're seeing where the workspace is reimagined as a place for collaboration. And it's maybe in smaller groups that come in for one day. So maybe on 2 days a week, you'll have maybe accounting come in on Mondays and Thursdays, and finance come in on a different day, or marketing a different day. But so we're seeing that there is a way to collaborate in person, as well as take that offline and do some independent work at home, then come back for the collaboration back in the office space again. So I don't think that we're dead when it comes to office space. I think that's going to be reimagined. And what we're seeing currently with a lot of our occupiers in the office space is that there's, again, a kind of a split model. Some saying we will never return to the office space. We will just work remotely. While others say, we need more office space. Thanks to social distancing measures, we need to figure out how we can have additional footprint and create an area where it's a safe zone for people. So I think as we all try to figure this out, because we're so new into this, I revert back to the concept of my children's school too. They're saying the same thing. What do we do come fall? Are we going to work remotely? Are we going to work, part-time at school? Or will it be a traditional model again? We're not sure what it's going to be yet still. It's still very early, but I do believe that there's a strong sense of identity that is related to the office space. And one more comment on the survey, what we did is we found that the younger workforce needs to be in the office more. And as they mature, they're more ingrained in sort of the work ethic and the culture of the business, and they're more able to work independently. But they really want the younger new hires to somehow feel connected to the company a little bit more. And that sense of place makes them more involved and more connected to the business.
Yeah, I completely agree with that. I think, there is a lot of value, again, as I mentioned earlier, to having people clustered together, not even just within, the same office, same company, but within, urban centers in general. I think you do get a lot of, like innovation, you develop a culture of innovation, of growth, when you do have that. And then a lot of times that does spur additional companies, startups. So I think there's a lot of value there that is lost from working from home. So that being said, I think there is going to be a push and pull here in the near term versus the short term. Certainly, you're going to see a lot of companies want to downsize and work from home just because we're in a recession to cut costs. But I think longer term, there's just a lot of value from working in an office And I think we look at other surveys too, where we see, the flexibility of working from home is what workers really value. So it's not, it doesn't have to be always work in the office and always work from home. They value the flexibility, like working 2 to 3 days a week from home, especially, for those that have kids and families. I think there is value to that. But at the same time, when you do go in the office a couple of days a week, you're still going to need the space. And I think, it's probably overstated that everyone just thinks, office is done. I think and you have a lot of people coming out of the woodwork that, saying that really have no experience in the space. But I think it is a little premature to tell, but I think in the long run, human nature kind of will come back to, we are social people. We want to interact with other people. And I think in a business environment, that's incredibly valuable.
One more comment real quickly on that, and backed by data. So only 7% of the world's population lives in the top globally 50 largest cities, yet they produce 40% of the economic growth. So there is that sort of, that collaboration does breed entrepreneurial development and really drives growth. So there is a sense of community which really fosters economic growth and is closely tied.
Thank you both for those comments. We want to be respectful of your time, and we do have 2 questions that I want to try to get through. We might go a few minutes over. This comes from the city of Centennial, and Gregg, I'm going to direct this to you. Is it realistic to expect neighborhood retail centers to transition to local distribution industrial, or will distribution continue developing and occupying newer industrial products?
The answer is yes. The answer is yes. We have projects right now where we're doing that. It's just another evolution of retail. It really is. I mean, the drivers of where to put your last mile fulfillment center are similar to where to put your shopping malls. They want to be close to consumers. It's just changing. It's bringing the product to the customer versus the customer going out and getting the product. I have projects right now where we have, again, shopping centers where we're redeveloping, carving some out and putting multifamily or industrial into those. So yes, it is. I think it's something that communities have to get used to. I try to be brief.
No, that's perfect. And one more question. This comes from Michael Patton, and I'm actually going to direct this to Mike, and then Gregg, feel free to chime in and elaborate quickly. Will we see a migration of work locations from downtown Denver, the central business district, do you think, to this more suburban location in Denver South?
I think there's certainly the possibility for that. Obviously, too early to tell, but I mean, the trend has been now urban flight, right? I mean, everyone wants to get out of density, out of urban centers, out of places where you rely on public transportation. So I think right now is kind of when you could see Denver South take advantage of that. You're seeing a lot of people look, to buy homes now in the suburbs. So you're seeing a lot more of that. And I think, that is an advantage that Denver South has. So I think certainly in the near term, that can be taken advantage of. And then I think when you look at, the CBD in terms of where rents are relative to areas in Denver South, I mean, you're getting a huge discount relative to downtown Denver area. So I certainly think that could be a trend in the near term. I think you're going to get more people, wanting to have more space working from home. So what could happen here is, someone might still be working for a company that is based in downtown Denver, but they move to a suburb somewhere down Denver South. So they're living in Denver South, but their office is in downtown Denver. So that gives you the opportunity to, kind of pull some of that talent down to Denver South and into a suburban office, if you're able to attract them to a different type of job. So I think there is that dynamic that plays out on a micro level, within Denver. But I mean, it is probably a little premature to tell whether that's an actual trend or not. It's pretty speculative at this point. But I mean, given the overall urban flight trends that we're seeing happening now, I think, certainly possible.
Thank you very much for that. And Greg, I'm actually going to have you very, very quickly elaborate on that. As part of kind of the site selection or location analysis process, how do we capitalize on some of those strengths here? And then I'll have Chris Shepard wrap us up.
Wow, we have 30 seconds, right? To Mike's comment, the commuting by car is something which is great right now. It's very pushed right now. As I said earlier, business is driven by either maximizing return or mitigating risk. And right now we're in a mitigating risk mode. So you can maximize return by lowering your cost by going to a suburban area because people are working remotely anyway. You don't have that sort of confluence of people working together in a downtown core. So it's the suburbs, and Forbes also mentioned in their article about the areas that are going to be quickest to recover are those areas that have ability to spread out a little bit more. And Denver has that ability to spread out. So how do you really leverage this going forward? I still think your biggest draw, we talked about it earlier too, is you're getting Denver to me is that bridging location where you have the Midwestern sort of values when it comes to work ethic, but you also have the eternal optimism of the West Coast. And that's where Denver meets. You have the bright, future of the West Coast, optimistic perspective, but you also have the core values. And it's an aspirational city for many people in America to live in. So, I say keep doing what you're doing. You guys are doing great. You look at other cities across the country. Denver's south is pretty awesome.
Wow, that's a great way to wrap up the program this morning. Thank you. Thanks, Becky, for handling the Q&A. We're sorry we didn't get to any more questions, but please send them our way and we'll forward them to our speakers if you have any more questions. Mike and Greg, you guys have been fabulous this morning. Thanks for getting up so early and joining us. Great perspectives, great information for what we need to focus on with the trends that you're seeing and the new way of thinking. So we plan on taking advantage of those things. So to our attendees this morning, we appreciate your attendance. Hope to see you at the next partnership meeting on August 6th. Right now it's to be determined if it will be in person. We certainly hope so. We would love to see you. So have a great day. Thanks for coming.